Hi everyone, my name is Monica and I am an insurance broker, and I wanted to show you guys how a life insurance policy could be used for college savings funds for a 4-year-old male in the state of Texas. And once I spoke with the parents, they wanted to pay, they could afford to pay $100 a month, which is $1,200 a year, which would purchase their 4-year-old male son, male son, of course, son, $445,000 of death benefit, right? So here you'll see the way that I did it was I set it up where they would pay from the age of 4 all the way until the age of 17, as you can see there. Okay, that he would pay $1,200 a year or $100 a month. He would have about $13,695 of cash accumulated by that time. And also he would still have pretty much $445,000 worth of death benefit. Okay, so with the time that he would be in college, and the way that I set that up is that the parents would no longer pay for would stop paying through the times in which he is in college for 4 years. Okay, that's maybe 4 or 5 years there. And each year he would have accumulated some cash there. So he could take this money tax-free. Either he can pay for his college, and we know that college is very expensive. It's going to be very expensive back in 20 years from now. It'll be very expensive 20 years from now. He can use this money to pay for college. He can use it to pay for school books. He can use it to pay for car notes. He could use it to pay for anything he wants to. You know, nowadays they live in apartments. We lived in dorms when I was growing up. So he could pay his rent every month with this money. Okay, so and he would have his death benefit. So if he were to use that money, however, what they would do is subtract that money from whatever the amount of money that he used from his death benefit at the time of death. Okay, so that's what I wanted to kind of show you. So how I set that life insurance policy up, real quick, is that he would graduate from college, and we'll say that maybe he gets a job. But if he does not get a job, it's up to the parents to see if they wanted to continue to pay this, or the child would pay this. I actually would, when I talked to the parents, they said that they would continue to pay for so long, and they upped it to $150 a month. Okay, so since they upped it to $150 a month from the age of 23, they're going to do that until he retires. So eventually I'm sure that the son would take over the payments. But to make a long story short, it was now the life insurance policy is going to be used for retirement whenever the 4-year-old retires. So he would pay $150 all the way a month, all the way until he reaches the age of 65, which is retirement age, right? If he does pay that amount of money and does not touch that money, look at the cash value that he would have at age 65. $543,000 and $734. $500,000. Okay, that's how much money he would have at 65. How many of us have $500,000 or $500,000 in our savings waiting on us when we retire? We don't have it. Okay, so we need to try to use our investment, use our life insurance money. Instead of letting the carriers use our money, we need to use our money that we're investing in this life insurance policy. Now, this also comes with, and also too, by law, you see that his death benefit has also risen to $652,481, right? And by law, you can't have, per the IRS, you can't have more savings or cash accumulated value more than your death benefit. So it does have to raise. Okay, so it does have to increase. I'm sorry. So with that being said, he would no longer have to do make any payments at the age of 65. So from 65, you see all of that. That's cash value that he would accrue. Cash value. Look at the age. He's still 70. At 78, he would have, not making any more payments, he would have $1 million and $1 million in 291 in his death benefit. Okay, so what I'm trying to get you to understand here is that you can take a life insurance policy and use it any way that you want. Use it while you're living. You don't have to die in order to use it. Also, with this insurance, life insurance policy, he has living benefits. What are living benefits, you ask? Living benefits are, say, if you would if he would get hurt, have an accident, have a terminal illness, have a chronic condition, kidney failure, lupus, anything that is a chronic condition that would prevent him from doing any ADLs, and ADLs are activities of daily living. So that would prevent him from feeding himself, that he could no longer walk, that he could no longer put on his clothes. You only need 2 of them. Once you do that, then they would pay you money for that. They would pay you the lump sum money, or they'll pay you monthly for it, so that you can pay and hire your own nurse. How many of us would need nurses to come out and see us? And if we don't have any insurance, we can't afford to have a home health agency come out and see us. So we would actually have our money there and use our money for just that, long-term care benefits. How awesome is that? That is just awesome. So my point being is, this is a life insurance policy from a 4-year-old male in the state of Texas that that has cash value, that all the way increased, used twice for a college